Hello and welcome. There are a few decisions in life that shape our future in lasting ways. For many people, buying a home is one of those defining milestones. It is more than just four walls and a roof. It is about planting roots, creating memories, and building stability for years to come. But as exciting as it is to look at homes, compare neighborhoods, and imagine where the couch or dining table might go, there is a critical question that almost every homebuyer faces. Should I lock my mortgage rate right now? It may feel like a gamble. Do you lock in today's rate and secure certainty? Or do you float and hope the market drops, saving you thousands of dollars over the life of your loan? For many buyers, this is one of the most stressful parts of the entire home buying process because it feels as though you are being asked to predict the future of the economy, something that no one can do perfectly. The truth is that this decision is not about predicting the future with precision. Instead, it is about understanding the landscape, weighing your options, and making a strategic choice that fits your financial goals and your tolerance for risk. By taking a step back and looking at the bigger picture, you will see that you do not need a crystal ball. You need perspective. So let's start with the basics. A mortgage rate lock is essentially a promise between you and your lender. It guarantees you a specific interest rate for a set period of time, usually 30 to 60 days, between when you apply for your loan and when you close on your home. The purpose is simple. If rates rise during that time, you are protected. Your lender is obligated to honor the lower rate you locked in, and that protection could easily save you tens of thousands of dollars over the life of your mortgage. Imagine locking in at 6.3% when the market suddenly spikes to 7%. On a $350,000 loan, that difference could cost you nearly $75,000 in extra interest. That is the power of locking a rate. The alternative is floating. Floating means you have not locked in yet. You are essentially waiting to see if the market moves in your favor. Floating can feel exciting, even a little thrilling, like sitting at a poker table waiting for the next card to turn. But remember this, you cannot close on your loan without eventually locking. At some point, the decision must be made. There are also hybrid options. Some lenders offer what is called a float-down provision. This allows you to lock in your rate for protection. But if rates drop before you close, you get to adjust down to the new lower rate. On the surface, it sounds like the best of both worlds, but of course there is a catch. Float downs usually come with a fee, often 0.5% to 1% of the entire loan amount, and they often require that rates fall by a certain minimum before you can take advantage of the lower rate. On a $400,000 loan, that fee could be $4,000, so it is not something to enter lightly. It is also worth remembering that a rate lock is not bulletproof. If your financial picture changes, if your credit score falls, if your debt-to-income ratio shifts, if your loan amount changes, your rate lock may no longer be valid. And if you do not close before the lock expires, you may face an extension fee. Even that small extension can cost several $1,000s. The protection of a lock is powerful, but like anything in finance, the fine print matters. Now, let's step back and look at the broader picture. Mortgage rates do not just move randomly, they are shaped by powerful economic forces. Many people assume the Federal Reserve directly sets mortgage rates, but that is not entirely true. What the Fed actually controls is the federal funds rate, the short-term rate that banks charge each other for overnight lending. This policy influences the broader financial system, but it is not the direct number you see on your mortgage. The real benchmark for mortgage rates is the yield on the 10-year Treasury note. Mortgage-backed securities are long-term investments, and investors use the 10-year Treasury as the closest comparison. When investors expect higher inflation or stronger economic growth, Treasury yields rise, and mortgage rates follow. When fear and uncertainty take hold, investors pour money into Treasuries, yields fall, and mortgage rates often move down with them. As of mid-September 2025, the Fed has cut interest rates for the first time in nearly a year. They did this because the job market is weakening. Job openings are falling, layoffs are on the rise, and employers are cautious. But at the very same time, inflation remains stubborn. Tariffs, supply chain issues, and energy costs are keeping prices elevated. This creates an unusual mix, a soft labor market paired with sticky inflation. Even Fed Chair Jerome Powell has admitted that this is uncharted territory. For borrowers, the impact is real. Mortgage rates recently dipped to about 6.35%, their lowest level in almost a year. Homebuyers have noticed, and activity has surged. Yet, forecasts from major institutions like Wells Fargo, Fannie Mae, and the Mortgage Bankers Association suggest that this dip will not last. Most of them expect rates to climb back toward 6.7% in the coming months. That might not sound like much, but even 1/3% can translate into tens of thousands of dollars over the life of a mortgage. Choosing to float right now is essentially a bet that the experts are wrong and that the market will move in your favor. Sometimes that happens, but it is a risky bet to make. Of course, the economy is only half of the equation. The other half is personal. One of the most important personal factors is your credit score. Your score is the single biggest determinant of the rate you will be offered. A higher score tells lenders that you are less risky, and they reward you with a lower rate. Even a small increase in your score can mean significant savings. Moving from a 679 to a 720 could lower your rate by 0.5%, which can save you tens of thousands of dollars over time. This is why it is so important to check your credit report for errors, pay down balances, and avoid opening new accounts before applying for a mortgage. Your timeline also matters. If your closing date is 45 days away, but your lock is only valid for 30 days, you are going to run into problems. You might have to pay for an extension or risk losing your locked rate. Matching the lock period to your timeline is critical. It sounds simple, but it is one of those details that too many buyers overlook. And then there is your tolerance for risk. This is less about numbers and more about peace of mind. Some people value certainty above all else. For them, the thought of rates climbing while they wait is unbearable. For those people, locking early is worth it, even if rates dip later. Others are more comfortable with risk. They might prefer to float and hope for a better outcome, knowing that the gamble could pay off. Neither approach is right or wrong. It comes down to knowing yourself and your comfort level. So how do you actually make the decision? The simplest way is to align your choice with your circumstances. If you have found a home, you are close to closing, and your credit is solid, most experts would agree that locking now is the smarter move. Rates are near a one-year low, and forecasts point higher. Protect yourself while you can. If you are still shopping for a home and you are comfortable with risk, floating might make sense, especially if you can secure a float-down option with your lender. And if you are buying a new construction home that will not be ready for 6 months or longer, a long-term lock may be the safer bet, even if it costs more upfront. At the end of the day, this decision is not about predicting the future. It is about managing risk. Before you make the call, take a few steps. Get pre-approved, review your credit report for errors, compare quotes from multiple lenders, make sure your lock period covers your closing date, and talk to a trusted mortgage professional. There is no perfect decision. Markets will always move, forecasts will always shift, and even the most seasoned experts cannot call it exactly right every time. What you can do is make a decision that gives you peace of mind. So ask yourself, would you rather gamble on the unknown, or would you prefer to lock in certainty and move forward with confidence? That is the power of making a strategic choice. Not based on fear or luck, but on knowledge, preparation, and alignment with your goals. If you found this video helpful, make sure to like, subscribe, and stay tuned for more tips and strategies to grow your financial knowledge.